We obsess over growth stocks. We analyze crypto. But nobody talks about the dividend investor. Six-figure portfolio, cash hitting their account monthly, and still not quite convinced it's real. Disciplined but perpetually uneasy. And it all traces back to one moment when paper gains turned out to mean nothing. Picture this. It's 2007. You're 38. Your brokerage account is up 26% for the year. You feel genuinely smart about money. Then a coworker mentions her rental income. $800 a month, reliably, regardless of what any index does. She's not richer than you on paper, but she sleeps differently. You can feel it. You file that away without knowing why. Now flash forward to March 2009, same brokerage account, down 48%. Every gain from the prior 2 years, gone. Not spent, not invested elsewhere. Just numbers on a screen that used to feel like wealth and now feel like a lie. Your coworker is still collecting her $800. Smaller tenants maybe, same check. The wound this opens isn't about money, it's about trust. The dividend investor isn't chasing yield. They're rebuilding trust in a system that once showed them wealth can disappear without warning. And every cash payment is a small proof it hasn't. Here's the first weird thing about dividend investors. They know the math. Ask any serious dividend investor if growth stocks outperform over a 20-year horizon. They'll say yes. They're not ignorant. They chose cash income anyway. J.P. Morgan's 2023 Guide to Retirement found that from 1980 to 2022, dividend-paying stocks in the S&P 500 returned 9.18% annually on average versus 2.61% for non-dividend payers. Dividend payers won. Over that full span, yes, cherry-pick the last decade and growth dominates. But across 40 years, the dividend investor's supposedly inferior strategy holds its ground. Your Uncle Dave, portfolio full of Coca-Cola, J&J, Procter & Gamble, calls it boring. It isn't. It's not conservatism. It's pattern recognition from a data set growth investors haven't lived through yet. Here's something that confuses growth investors when they study dividend portfolios. Every dividend is a taxable event. You didn't sell. You didn't choose. The company distributed cash and the IRS immediately wants a cut. In a taxable account, dividend income triggers 15% to 20% in federal tax before you've decided anything. Vanguard's 2023 tax efficiency analysis found dividend-focused funds generated 23% more taxable distributions annually than comparable total return growth funds in taxable accounts. Your neighbor James, $400 dividend check in March, $60 to taxes. He reinvests $340. The growth investor next door paid nothing. Nothing was distributed. Nothing was sold. James doesn't care. The check is the point. It's not inefficiency. It's the fee he pays for certainty delivered in cash. Here's a stat that surprises new dividend investors. Not all dividends are equal. A 9% yield on a declining stock isn't income. It's the company returning your own capital because it can't grow. This is the dividend trap. The yield looks attractive, the business is shrinking. S&P Global's 2023 Dividend Aristocrats analysis found that stocks yielding above 6% in the S&P 500 underperformed the broader index by 4.3% annually over the following 5 years. Sarah, in 2021, bought AT&T for its 7% yield. Stock fell 25% that year. The dividend was cut. She lost on income and principal both. It's not greed. It's the psychological pull of a high number in a world that stopped offering reliable ones. But here's the twist. Growth investors have a math problem of their own. Growth investing works brilliantly when you hold through volatility. The problem is almost nobody does. A 40% drawdown tests something psychological in most investors that a quarterly dividend check never has to. Morningstar's 2023 Mind the Gap study found growth fund investors captured only 71% of their own fund's returns due to poorly timed entries and exits, a 29% behavioral drag. Your friend in 2022 bought QQQ, the Nasdaq 100 ETF. In late 2021, at the peak, down 33% by year-end, sold in January 2023. The fund recovered. He didn't participate. The growth investor isn't wrong about the math. They're wrong about themselves. It's not bad investing. It's overestimating your tolerance for watching numbers fall. Here's a stat that changes the dividend versus growth debate. Reinvested dividends aren't just income. They're compounding units. The math on reinvestment over decades is completely different from taking the cash. Hartford Funds' 2023 dividend research found that $10,000 invested in the S&P 500 in 1960 grew to $641,000 by 2022 without reinvestment, and $4.4 million with dividends reinvested. Same index, same period. 6 times more wealth. The dividend investor who reinvests every payment isn't choosing income over growth. They're choosing a compounding mechanism that forces discipline they might not otherwise maintain. Christine, 55, auto-reinvested dividends since 1998, never touched the income. Her portfolio is twice her brother's. And he picked tech stocks. It's not yield chasing, it's force compounding, disguised as income preference. Let's talk about the number that actually determines which investor wins. Not the yield, not the PE ratio, the number of years you stay invested. That number looks completely different between dividend and growth investors. Dalbar's 2023 quantitative analysis of investor behavior found the average equity investor held positions just 4.25 years. Ned Davis researches 2022 data found dividend-focused investors held for an average of 9.3 years, more than double. That holding period gap accounts for most of the long-term return difference, not the strategy, the behavior. Robert, 61, owned Realty Income since 2003, 20 years. Monthly dividends, never sold. It's not patience as a personality trait. It's the dividend check removing the psychological trigger to act. Every contradiction points at the same origin. The dividend investor isn't optimizing for return, they're optimizing for proof. Cash in the account is proof the system is working. Paper gains require trust, and trust is exactly what 2009 removed. Remember that coworker with rental income in 2007, the one who slept differently? You didn't understand it then. You do now. She wasn't richer, she was more certain. And certainty, it turns out, is worth the tax bill. The real math isn't which strategy returns more, it's which strategy you'll execute through a 40% drawdown. For most people, the answer involves a check landing quarterly, whether the market agrees or not. Drop a comment, dividend or growth, and has a market crash ever switched you? Subscribe. Every week we unpack the psychology behind the money decisions you think are purely rational.